Hello, ladies and gentlemen. My name is Sergey, Ilchenko, head of Quant department at Vermont. And first of all, I would like to thank all of you for coming out to our Investor Day and to attending my presentation. If I will be heard not really loud, tell me and I will switch to this mic. So, quants, trend following algorithms, and robots. For some of you, this may sound even too alternative for alternative investments. My purpose today is to show you how the quant funds work and how to get twice return as that of the index with twice lower volatility. I've got three quotes for you today, which sound for me very appropriate. I will read it. What's needed is sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. The sillier the market behavior, the greater the opportunity for the business-like investor. That's the quote from Warren Buffett. Martin Scholes told he is Nobel Prize winner in financial economics. I'm very bullish on the future of quants. It should be the golden age for risk modeling and management. George Soros told, even a cursory look at commodity, stock and currency markets confirms that such trends are the rule rather than exceptions. Why it is important for us? First of all, the unemotional decision-making process. Secondly, the statistical analysis. Thirdly, the inefficient markets. These 3 points should be taken in mind while I'm doing this presentation. First, a cursory look at what happened to the financial thought in 20th century. The first managed futures trend following fund was launched by Richard Donchan in 1948. Here's a picture of him. He is a founding father, like Dieter Vermont is founding father for Vermont Asset Management. He is a founding father for trend following strategies. From 1950s to 1990s, the development of financial theory has been done. It was started by Harry Markowitz with his modern portfolio theory, and was continued by Eugene Fama with efficient market theory. The theory which dominated financial thought for many years, and it was believed that the market is either efficient or tends to be efficient or tends to equilibrium quickly. We know that now it sounds not really true, and as of now 60% of trade volume is in US market is generated by algos, and $2.7 trillion are under management of the quant funds. What happened to the financial thought afterwards? Black swans, fat tails. These ideas have been developed just to make all ideas work. All these things I would call it as a broad field called behavioral finance. And for me, it sounds like a hammer nails in the theory just to make everything work. And one thing is clear, that the human irrationalism is underestimated, and the markets tend to be inefficient longer than the investors stay solid. George Soros told in his book that hallmark financial theory should be rewritten with his theory, with the use of his theory of reflexivity. He said the markets are not efficient at all, and his investment approach is actually based on the forming of bubbles, etc. I borrowed this slide from the IMF report, which shows financial stress for last 30 years. The gray line shows the financial stress index, which captures the market performance with FX and volatility. all over the world. You can see that 3 financial crises happen every 10 years, every decade. That's quite often. So 3 financial crises. If you take maybe 10 years, you can see that even the number of countries for each crisis increased. The number of countries shown in the green line is advanced economies and emerging markets countries. This number of countries stressed in this crisis. And so it's quite a scary picture. Why is it important? The crisis means volatility. Volatility means opportunity for the hedge fund managers. And for those hedge fund managers who stand out from their peers, they are the winners until the next crisis happens. So, if I may, I will go on a short tangent and discuss who the quants are. Firstly, the quant area has earned bad reputation because of the perception that it's all about the black boxes, the voodoo analysis, the astro trading. We are not talking about that at all, so we do not belong to that. The rest of the other category is based on the statistical analysis, on the sound practices which we developed in performance management as well. So, who the quants are? Approximately half of the quant funds represent the statistical quants who are based on the fundamental indicators, who can manage a lot of securities by the computerized quantitative or qualitative methods, and that's the biggest part. Approximately one quarter is technical trend following funds, and the other 2 parts are divided between other technicals and high frequency trading. I would put our strategy, ourselves, somewhere in the middle between trend following and the classical quant. For the reason because we are using fundamental inputs for stock picking and statistical approach to develop trend following strategies. So let's come back to the crisis. That picture is not that complicated, it seems, for the first view. And it reflects a really simple thing. If a portfolio drops X% from peak, you will need to get Y% to return to the previous level. That's the curve which just shows how much percentage you need to return to the previous level. For example, RTS dropped 79% from peak to trough 2008, and it required 400% to return to the previous level. It gone only 2/3 of this path. Approximately similar situations S&P 500. Vermont Quant Eastern Europe strategy was only 22% down in 2008. It gone all the path back, and similar performance even further. You can argue, of course, for the indices, it just takes time to return to the previous level. But I have 2 arguments. First of all, it may never happen, like Nikkei or Nasdaq. The second is the emotions. If, for fund manager, if your portfolio dropped 50%, what you will do next? That's quite an emotional question, and it's hard to distance yourself from the emotions when you make a decision. For the reason these managers exist, the trend following system works. If we take a closer look at the performance of Vermont Quant Eastern Europe strategy versus the RTS. RTS is a light blue line, and the Quant strategy is a dark blue. We can see that from 2006, I just chosen the worst performance months through all this period. It was obviously almost all May since 2006. And 2006, May 2006 is minus 11.8% for the RTS, and it was plus 3.7% for the strategy. It was 8% down May 2007 and plus 0.4% for the strategy. The year 2008 was especially spectacular. We all know about that. And the last month, August 2011, was also a good example. Minus 13% for the RTS and minus 2.2% for the strategy. For the reason that we showed here, the downside protection. And for that reason, the dark blue line is above. So, downside protection is alpha. It's not always understood very well by the investors and hedge fund managers. So, downside protection is alpha. It's a really simple example. I would like to show you how the trend following strategy works. Classical investor asks what and where, and we ask when and how. What does it mean? It means that the fundamental analysis can tell you what is the fair price, but it will never tell you when this price will be achieved and how. For us, it matters when and how. For example, you take a stock and with the price of 195 rubles, and you analyze the stock at this point of time and determine that the target price is approximately 227 and it's time to buy, it's a good opportunity, you buy it, and the buy and hold strategy gives you 18% performance at the end of the day. The trend following strategy would enter only at this level when the trend starts. So it delivers 26%. I would like to pay your attention to the main characteristics of the Quant strategy. First of all, the alpha-driven approach, we discussed that. So, in addition to that, what differentiates us from the others is that we have quite conservative limits on the leverage. We are only 100% maximum on the long positions and 30% maximum on the shorts. We also use statistical analysis for developing trend following strategies with different time horizons. We use fundamental inputs for stock picking. And what is important to say, we use only securities which are liquid. So, liquidity is actually an important thing because very often it is a big concern for the investor who invests in Russia. Our liquidity risk management rule is extremely simple. We can liquidate whole portfolio in one day without significant price deviations. Our investment process starts from development of the Quant strategy. We test it for various liquid and volatile stocks. And once it's developed, it is tested. And then we go to the implementation process. We apply the fundamental filters, which means that we are not buying those stocks which are extremely overvalued. We are not shorting those stocks which are extremely undervalued. We apply also a risk overlay system which concentrates the portfolio position by position, such that there will be no big position, so it's just diversification. We also do hedging against ruble. That's one of the main risks for dollar investor into Russia. And always constantly monitoring the process and look at the P&L of each system regularly. We also control on the liquidity situation in the market at any times, so the universe of stocks can be changed over time. Those securities which appear to be liquid, they are included in the stock universe. Those which become less liquid, they are excluded. At the moment, we are using approximately 40 Russian stocks of 20 companies. There are ADRs, ordinary shares, etc. The performance overall proves that we can achieve the double return than that of the index over time. That's the statistics from August 2005, with the volatility which is twice lower. You can see that anyway the correlation with the RTS stays still high at 75%. Yes, it's still high, but you cannot make it lower with such high returns. So 75% should be taken cautiously, because you always need to remember that there is a downside protection. So on the up market, the volatility, the correlation is high. On the downside market, it's not that big. So that's basically the results of the quant strategy which we are doing at Vermont. I took Russia-focused funds from Bloomberg and decided to compare what are the performance in 2011, which was of course volatile market and was a challenge for many hedge funds managers. You can see a little here, it's us. So it's year-to-date performance, and you can see it ranges dramatically from minus 50% to plus 4.3% year-to-date. Similar thing was done from January 2008. It was proved that it's also quite good. We also have strategies which are doing in the US market. They're somewhat similar, a little bit more aggressive, and that's the results from September 2010 for the Quant global strategy. So it delivered 200% cumulative performance net of all fees versus negative S&P. So that concludes my presentation. If you have any questions, you can ask me or also Yuri, who is our head of quant strategies.
To ask two comments. First comment, how can you have such a high correlation in the last years? Because 75% is a lot.
Yeah.
And second comment, could you comment on the performance of August plus 10%?
Well, first of all, the correlation with RTS it is difficult to make the correlation low with keeping expectations of high returns. So on the up market, the correlation is high, and all the strategies tend to move with the index on the up market, and such times they happen more frequently than the downside, right? On the downside, which I already told you several times, we show the protection on downside level. And then this is the time when the correlation decreases. That's what you have to expect for the manager at this period of time. So that explains you why still the correlation is high. But if you actually look at the other statistics, for example, the skewness, it's kind of more, I don't know, it's not really often used to compare, but skewness is positive, while for the other hedge funds managers it is negative, which means it is likely to see high positive returns than negative returns. The second question was about the August performance. Yes, it was quite good while the market was falling. So there was huge outflow from the Russia, the funds there was huge outflows in the funds. Such cases, basically, that's the cause of market inefficiency, right? So those market is efficient when it is easy to move funds. With Russia, it's not the case. There are anyways some tensions and difficulties with this process. So that makes the increases inefficiencies in the market which we are using.
If the market shows a very pronounced and long-lasting downtrend, right? Mm-hmm. Why aren't you making money on what's your maximum short position which you can take? I mean, if you can go as much long as you go short, you know, even a weak market, at least theoretically, should be generating nice returns, as long as you have a strong trend, right? So why, I mean, this is, I'm following Jean's question.
Yeah.
Why are your performance negative?
For Russian market,
Yeah.
because
there's a liquidity problem, right?
no, that's not the case. For Russian market, we tend to be on average net long the market. We have only the mandate to go 30% short on the market, but on average it could be flat. If you take, for example, August this year, on average we were more or less flat, so 0% exposure. There were long positions and short positions. We cannot go straight short, although in the US strategy we do. And if I go to the US strategy, you can see what it.
But it was down market, right?
Yeah, it was down market. It's an uptrend for the strategy. That's more aggressive strategy.
That's because they're more liquid.
No, the liquidity is not an issue. I already explained several times. The liquidity creates only the situation that the number of stock universe is not that big. And that's the only thing. So it's never an issue with liquidity. But for the more aggressive strategy, it may be an opportunity to go short 100%, and that's the result.
What is the capacity you have in this strategy?
Yeah. At the moment, it's about $20 million managed with the quant strategy at the moment. We have a mandate actually for the European quant. We call it Eastern Europe strategy. So we have a mandate to go to the other markets, and we're planning to expand. And we estimate that the capacity of this strategy to be somewhere between 500 million and 1 billion. And for approximately the similar situation with more aggressive strategy which is trading in the US. So another 500 to 1 billion. Any more questions?
Sergey, can I ask you a question
Sure.
about this? So if you were to draw a line from May 89, have you not underperformed the market?
I think it's useful to say, Yuri, what was the performance in 2008? The index was down how much, and the fund did how much, and what did you do afterwards?
Can you turn?
Yes. 2008 performance. Yeah. In 2008, S&P 500 fall by almost 60%, and our strategy showed 160%. In 2008 it was plus 160. It was a fantastic year. 2009 it was also a good year. The S&P grew 25%, and our strategy has made about 30% net of all fees. The only bad year was last year, 2010, as it was for a lot of trend following funds, because the market was quite choppy for our strategy, and our global strategy lose about 8%. But yes, this year we see volatile market, so our global strategy again it works quite well, plus 12% year-to-date net of all fees, and we hope it will continue for some time.
So the message is that these funds like volatility.
Yeah. Global strategy likes volatility. Yeah. And Eastern Europe strategy is more conservative. It likes uptrend or downtrend also, but it doesn't need volatility as global strategy. So if you want to invest in Russia with downside protection, Eastern Europe is your choice. If you want to find some alternative investments with zero correlation to market, with high return on volatility times, then global strategy is a good choice. So we have two different products. Thank you.